Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Stash Graham, Managing Director at Graham Capital Wealth Management, Andrew Briggs, Wealth Manager at Plaza Advisory Group, and Jeremiah Riethmiller, Chief Investment Officer of 213 Strategic Partners. They join us to discuss the markets and economy and if we'll return to normalization in contrast to the past couple of years. We saw some volatility following the COVID pandemic. It is great to have all of you with us. Welcome to Trade Talks. And Andrew, that's really what the question is. Is this the return to normalization, or is it just a different market environment in general now that we're through the pandemic?
Yeah, no, I think it's certainly, to say the least, has changed quite a bit since the pandemic. Lightly put, came from a quantitative easing, ultra easy monetary policy, low rates, non-existent inflation, striving to get any type of growth going. And now here we are based off kind of the opposite situation where supply chain issues induce some inflation that's still lingering, change the labor market to be tighter, quantitative tightening. And then I would say the other largest wild card in there is the fiscal side of things as well, which continues to get more attention on the amount of spending and from a percentage standpoint, from a GDP standpoint.
Yeah, and Jeremiah, I'm sure you would agree that we're really at this crossroads here between inflation, interest rates, what Fed policy is going to look like moving forward. Is it a soft landing, no landing, hard landing? I mean, is there even a way to identify it at this point?
I just hope we land, right? I mean, every time you come out of one of these cycles, you're trying to figure out what is different this time. I would agree with you. The Fed policy and interest rate environment is the 2% target. I think, is that really the right target? If you look back historically, if we're trying to go from 6.5% inflation to 2% inflation, the last time we had to come down from 6.5% inflation was in the 80s. Now, a completely different environment. The Fed funds rate never got below 8.5 in the 80s, and it took us. We didn't get to 2% inflation until the year 2000. So it's a very different environment. I don't know if 3% or if 2% is the right target. It might be 3%. The economy, we're still growing it. Real GDP is growing at 3% year over year. Maybe we figured out how to manage a 4 to 5% inflation coming out of this cycle.
Yeah, and Stash, that's a good point that's made, right? Because from a historical perspective, we are in a relatively normalized rate environment. It's just over the past, let's call it 10, 12, 15 years, we're so used to a system flush with liquidity and virtually zero interest rates. There's a lot of short-term memory that has to be worked through there.
Right. And to Jeremiah and Andrew's point, we were discussing interest rates. And really, when we go back to the great financial crisis, I know there's been a lot of focus on the pandemic, but to Andrew's point earlier, you go back to the great financial crisis, we had very low interest rates. You had quantitative easing. We had negative real rates. To Jeremiah's point, he referenced real GDP. We had negative real rates for the better part of the last 15 years. And what makes this dynamic currently right now very interesting is 5.5% for a treasury. Real rates right now, 2.5 to the good, positive. It's just a different environment now than, say, where we were the last 15 years. And I think we're still in that point where market participants are recalibrating how to operate or invest in this environment.
Yeah, but yet here we are, right? The market was pricing in 6 to 7 rate cuts in December. We haven't seen any in 2024. Perhaps maybe we'll get 1 or 2, but here we are. The markets are sitting at nearly all-time highs here. So to everyone's point earlier, Stash, you're working, perhaps, corporates, they've understood how to work through this kind of environment.
They've certainly termed out their credit. And I think that's one of the dynamics, and ourselves included, where we've been looking out the last couple of years, or looking back the last couple of years, and then looking forward to the next few years. There's a lot of debt that has to be rolled over. That, say, 2021, we were zero bound. Corporates were able to issue credit at 2.5 to 3.5 on a coupon. And it's starting to come due, say, in 2026, if we go back to 2021, let's say there's a 5-year corporate, 2.5 to 3%, and now it's coming due in 2026, and they're going to have to refinance at 5.5 to 6. Now, what's working in the corporate's favor is, you might say, well, that's 2 times as much interest expense. It's going to be very punitive. Well, we also know that capital structures right now are very healthy. There is a lot of equity. And so, yes, there might be a little cut due to that interest rate expense, but I think even more important to C-level executives is that capital markets are flush. They are wide open. We are seeing credit issuance, new issuance at record highs so far year to date, and people are waving it in. They're very happy with 5.5 to 6% for corporate credit.
And Jeremiah.
Yeah, the other thing that companies are watching, and you can see it in the earnings forecasts, is earnings forecast for the year is still 10% year-over-year earnings growth, but that's off of expected 5% revenue growth. So they're paying close attention to costs and margins, and so far margins in 1Q have been, and the 4Q earnings have been positive, and there's some margin growth there, so that's good to see. But they're being very careful to the previous point.
Yeah. And Andrew, you have noted that there's other structural forces and themes here at work, in addition to Fed policy, interest rates, and inflation. I mean, there's a number of demographic structural changes here.
Absolutely. Yeah, I mean, I guess when we discuss with clients, I think what's kind of helpful, and I think it's becoming more of a bigger theme, frankly, on a structural standpoint, is the stock market. It's not really the economy, unfortunately. They don't typically, or they're not going in lockstep one for one. I think a good example of that would be the fact that as we're just now getting last week, it looks like, which would be ultimately a good thing, we're getting some loosening in the labor market. Wage growth is kind of subsiding a little bit. Quits rate, we all know, has fallen. The forward guidance, I think Jeremiah just spoke to, when you look at what these companies are looking forward to, saying there's been some hesitance and concern there on how optimistic they are, depending on which sector you're looking at on their hiring. But then you contrast that with, back to the inflation narrative, which through the first 3 months of this year has, as we know, been extremely strong. You can argue some of the seasonality and lagging data, such as, the shelter and whatnot. But I think that does a good job of highlighting, just because, we could have theoretically a slower labor market, slower growth and whatnot, but inflation may not drop because that gets to that structural theme of the demographics. Last thing I'd mention there is baby boomers. This is kind of another thing coming out of the pandemic, have a lot of retirees. You can place the argument that, they're some of the most, well off net worth wise, disposable income versus prior retired generations. Therefore, the propensity to spend is still going to be there, which again, to some degree would keep a strong thumb on inflation.
Yeah, but you also noted that the working age population continues to shrink. I mean, we've seen the headlines in terms of birth rates around the world globally that continue to shrink. And then, that could also lead to less savings and less spending. However, it's been really hard to bet against that consumer, Andrew. I mean, even through the pandemic, look how strong they remained regardless of the stimulus checks.
Absolutely. Yeah. I mean, just look at the Q1 GDP print, 1.6%. On the surface, there's a lot of people saying this is a weakness and whatnot, but I think as Stash and Jeremiah would probably echo, if you dig into what the components of it are, that consumer, which has always been 60-70% of GDP, continues to be quite strong. Spending continues to be quite strong. And finally, to your point on the labor market, yeah, I mean, again, it is just a structural difference now where I guess two things going on. Obviously, immigration is another topic that it seems to be a hot topic as well on that, which is positively impacting, both the wage side and the unemployment side for now. But again, as people, if this is going to be somewhat of a tighter market relative to the past due to the exodus of baby boomers, that could also be inflationary. It should keep somewhat of an elevated wage pressure. Again, just relative to the past situation we were in prior to the pandemic.
Mm-hmm. And Stash, let's talk about investment opportunities here for a moment and how you're advising clients to be positioned with this type of macro backdrop here. It sounds as if from what the three of you were saying, at the end of the day, it's going to be about diversification within one's portfolio.
Certainly, as an industry professional that works with families and estates and trusts and businesses, they all have their own investment objectives and goals. So certainly diversification and the different types of asset classes, in addition to sectors on the equity side, is important. I would say looking out over the next 5 to 10 years, considering the backdrop to what Andrew was talking about from a demographics perspective, you are seeing a structural shift in, say, the baby boomer generation, who historically were your savers. They were 30, 40, 50, working, saving for retirement. Now they're cashing in. And we don't necessarily have the same relative size of that saver that we did before. And so there is some risks that we could see interest rates stay higher than maybe what we have seen or experienced the last 30 or 40 years. But that's a longer, say 10, 15, 20-year structural theme that I think people have to keep an eye on when they invest. But I think over the next 5 to 10 years, real assets are where you want to have your exposure. I think they probably, out of all asset classes, offer the best risk reward for the type of environment that I think we're still in the early innings of.
Mm-hmm. And Jeremiah, when you think about it from a global perspective, what regions look attractive here?
Globally, emerging markets are interesting. I think you've got we look at, I've got analysts on both ends. One's looking at India and one's looking at China. China that's been a rough ride, and we're looking at it from a value perspective. Now, that might get worse before it gets better. There needs to be some policy changes and shifts in China to get the consumer confident in spending, particularly in the housing market. The consumer's not buying a house unless they can physically see it because they've been burned already. In India, there's been a lot of growth and momentum there. So that valuation might be getting a little rich, but they have momentum on their side there. So if you're looking at emerging markets globally, those two places are interesting. I still like the US. Valuations are reasonable here. The long-term trend in US equities is higher. I tell clients it's like whitewater rafting. Like, you're in the river, we're in equities. The best you can do is avoid the big rocks, right? So there's certain risks out there right now, like concentration risk in the S&P 500 that we've talked to clients about for the last year and a half. I think at some point those will come to a head. I wouldn't try to pick one of those big winners. I'd stay diversified to the previous points.
Yeah, well,
US
I mean,
equities as well.
in the first quarter, the other 493 names outside of the Mag 7 in the S&P 500 returned an average of 8%. Annualized basis, I'll take that. So there definitely are more opportunities out there. But to your point, Andrew, and I'm sure you would agree, we need to see some broadening out within the market here too, to remove some of that concentration risk.
Sure. Yeah. And again, we really have seen this relative to 23, which was such a isolated year, as we all know. Clearly, the first quarter, the Mag 7, if you want to call them, the 7 names, they continue to do well. I will mention, unlike the tech bubble, I think we should agree that, the earnings have somewhat warranted it now. But the broadening out phase, is something that's important to us as far as, what else is there to pick up the slack, as opposed to trying to look through I think the old way of maybe some asset managers may have looked at it from just a pure, okay, which is a growth, which is a value name. We think you got to kind of change that up, and whether it's, broadly speaking, just by sector, or more importantly, looking at those quality names that exhibit maybe a combination of both value and growth historical characteristics. So to that standpoint, again, I think there are going to be certain pockets, certainly on the equity side, as Jeremiah mentioned, certainly globally speaking, to have a little bit more of an active stance, given, again, all these new structural changes that we've all been discussing. And then last thing I'd say, on the diversification side, Stash made a good point. Just taking things, from a timeline standpoint, certainly the good news is if you have any of our clients here are looking at, short term, no risk, the good news is there's a very good opportunity right there, and whether it be money market or even some short duration fixed income. Final point would just be, on now we are looking at the portfolio allocation, obviously much more cumbersome of the third leg, being broadly call it the alternative space, but whether that's real assets, as Stash mentioned, on the private side, or even on the public side, doing some type of hedged or derivative type equities, which allow you to stay invested, but you're not taking on one-for-one fixed income risk with that money.
Yeah. Well, Jeremiah, it's interesting, but you had noted here that private markets account for 40% of all capital invested in the US. It's more than double their share in 2009. Do you think part of that is with this attraction to alternatives, there's more liquid and just more products available to retail investors that they're able to access it? I think that's part of it.
Yeah, I think it is. The private markets, like you mentioned, they've been growing and growing for years, and they need access to more capital. And now they're coming up with ways to get access to more capital, right? Via interval funds, via evergreen strategies. So the environment for QP accredited clients to invest in the private markets, that menu is getting significantly larger. Now, it comes with its own risks, right, when you're in the private markets, but we believe that the private market growth will continue. The number of companies available to invest in public markets, stagnant, maybe declining. So we've been shifting allocations over time into private markets, whether it's equity, credit, real assets were mentioned earlier. I think those are all spaces where you should absolutely be thinking about allocating, especially long term.
Yeah. Stash, are you seeing the same demand from clients as well, where they want to get some exposure to the alternative space?
Jill, I would say the conversations we have had with clients is their focus on commodities. When you mention real assets, I think they start to really focus on commodities. Certainly there's discussion about gold and the rise in gold, admittedly, which is one of our larger positions at the firm. The rise is abnormally strong these last couple of quarters. But from our firm, our focus has largely centered around energy. That I believe is the real asset that has a very interesting value proposition over the next 5 to 10 years. Jeremiah was mentioned India. India is going to need more crude oil and more natural gas 10 years from now than when we're talking right now. And commodities very much so, especially energy commodities. It is a globalized product. So if you have an emerging market like India or Brazil, who produces a significant amount of energy, but if the growing demand globally for energy is going to be higher 5 and 10 years from now, then you're going to need to structure a supply in place to be able to generate that energy. And right now, you have seen over the last 5 to 10 years, for a variety of reasons, a lack of interest in allocating capital to this sector. Now, some people might say it was ESG these last couple of years. Some might say, well, look, you look at the last cycle from the great financial crisis to the COVID pandemic, energy was the worst performing S&P 500 subsector, and it wasn't close. And so people don't want to allocate money to that sector. Separately, you had 2 waves of bankruptcy within the energy space. So whether you want to get exposure to energy through exploration production companies, whether you want to invest in energy infrastructure, and I think of the subcomponents of the energy sector, I think that's very interesting. You know how tough it's been putting pipes in the ground for the last 15 years. There is a material advantage to people who have metal in the ground.
Yeah. Well, I think, that's an interesting point that you bring up, because perhaps it doesn't have to be, there's one magic elixir for all of our energy issues, right? Perhaps it's a portfolio of energy, whether you include renewables in there or not. The demand that EVs require, the demand that AI and all these data warehouses to power all these different types of structure. I mean, the energy demand plays, to me, is what's almost as interesting as the technologies that are being introduced themselves. So, maybe it could be a different type of energy cycle if you were looking at it from a portfolio perspective of different types of energy versus electricity is the winner or nat gas is the winner.
No, absolutely, John. And, this part of the thesis has really just started the last quarter or two, where people go, oh, we got to electrify the grid. We got to increase our capabilities. Well, how are we going to do it? And there's certainly been a lot of progress made within, say, the alternative renewable energy space. Solar has come leaps and bounds over the last 20 years. I think there's still some questions about wind. But look, you have natural gas. It's right here. You have seen some states make some interesting decisions these last couple of quarters in regards to what to do with natural gas plants. Maybe some were going to be sunsetted. And you know what? The state said, yeah, let's keep this going, because we need electricity at night when we can't necessarily produce the same amount of electricity because, say, the sun has gone away.
Right. Jeremy, final thoughts here? Jeremiah?
Yeah, I would add uranium to that too. And nuclear power, right? It's something that's been sort of taboo over the last 23 years. We're shutting down nuclear plants, but now we're thinking, well, maybe let's not shut that down. And then as a way to play all of energy, I like infrastructure, right? You have to build those pipelines. You have to construct that infrastructure. So I think there's money to be made in infrastructure, and you don't have to have this specific exposure to a specific commodity in there.
All right, gentlemen, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.